Hello everybody, David Hunter has been a common subject who I've talked about in several videos regarding his predictions of a coming melt-up in equity markets that would drive prices higher than anybody thought possible. Following that, an immense crash up to 80% after this melt-up, and since roughly a year ago, when he was calling for a melt-up when everybody was extremely pessimistic, the markets have slowly but surely come around, and now we are in this final phase in which prices are going up very rapidly in a very short amount of time. Today I will discuss what factors drove this melt-up as well as why this presents a very high possibility for return right now, but also a very high possibility in the longer term for risk, so stay tuned. Hello everybody, welcome back to the Contrarian. For those of you who are new here, my name is Logan. I really like to talk about overall success, investing, and most of all going against the crowd, because if you can go against the crowd, you can basically outperform the markets over the long term. So if you like these kinds of topics and you get to the end of this video and you want to hear more, just consider subscribing. So to get started, roughly 3 weeks ago I made a video discussing why both the technicals and also the fundamentals, namely with the shift in sentiment that was just starting to take place, had just started this final parabolic leg. And it appears I was a little too early, but in the last couple of weeks up until now, the markets have transitioned from what some were predicting would be a small correction to now sharply moving higher. And up until then, there had been a lot of skepticism in the markets, a lot of articles about how this was a bubble and how, it would all come crashing down, or at least, how it couldn't go much higher. And there was at least a lot of healthy skepticism going on. But now, sentiment has changed in a large way, and this factor is often overlooked as just how much sentiment affects the markets. It affects it a lot. If there's a significant amount of investors who believe a correction is coming soon, for example, however large or small they think it could be, chances are they aren't going to be as invested in the markets as they normally would be if they were very optimistic. They might be keeping some cash off the side, whether it's 20% or whether it's 50%. So up until roughly 2 to 3 weeks ago, this was largely the kind of doldrums the markets were stuck in. Not many more people were getting in than were already in. But this shift in sentiment is basically entirely what I would credit the dramatic jump up in the markets to right now. Encouraging statistics have come out. More importantly, the media is now presenting these in a very optimistic and encouraging way. Before they were slightly pessimistic at times. Now it's almost entirely very optimistic the way that they're presenting the statistics that are coming out. And skeptical investors who were on the sidelines are beginning to jump back into the markets, driving prices higher. Remarkably, last year David Hunter had a price target of 4,200 on the S&P 500, and that was when the markets were immensely beaten down after COVID, and everyone thought that was impossible, that was extremely far away. And it turns out the S&P 500 right now is only 1 or 2% away from 4,200, and now Hunter has raised his target to 4,700, and he has still stated that this will likely be a conservative estimate. So imagine if, the S&P 500 blows through 4,700 and goes up to 5,000 or something. I mean, that's the kind of move that you could be seeing in the coming months. He's also raised estimates for the Dow to 36,000, the Nasdaq to 18,000, and gold to 2,500. So these will truly be historic moves in a relatively short period of time. I just took a snapshot of this because I think it's a really, it really represents where we are right now. Just all of these indices are rallying, the 10-year moving down. That is part of what is driving the melt-up as well, is rates falling back down. Remember, rates rallied roughly from about 3 months ago to about 2 weeks ago. They were rallying. That was kind of putting a downward pressure on mainly the Nasdaq, but also some of the other stocks. And now, with rates falling again, that's another major thing that kind of helped to get this rally going, in my opinion. But, S&P 500 this morning up 30 points, and Dow up 229 points, Nasdaq up 143, crude roughly the same, gold moving up now, 10-year moving down, and I think all of these have continued to rally throughout the day so far, so it's kind of the same pattern of, yeah, just jumping up 1 or 2% each day at this point. It's really a historic time that we are in. So bottom line, we're finally in this final, parabolic stage of the melt up, which David Hunter has been talking about. And while this might seem like a very exciting and historic time, and don't get me wrong, this is a very exciting and historic time where, I'm in my 20s. I am very convinced I will not see a period in the market like this again in my lifetime. It is an extremely historic time. But it is also definitely not a time in which to get greedy. As the famous investor Warren Buffett has said, be fearful when others are greedy and greedy when others are fearful. And right now, and likely in the coming weeks and months, as investors will become more and more greedy, as they see other people making, 20, 30, 40% returns in just a few months. And they'll always fall into the trap of thinking, oh, they've achieved that, so I can achieve that as well. It's not always true. And it is at this point, once you have everybody in the stock market who possibly can be, when valuations are at historic highs, which they already are, but they will become even more so, and when leverage in the system in the form of derivatives and debt is at all-time highs. Again, it already is, but it will become even more so. And when the economy itself actually begins to really get going, consumers are out spending like they were before. It is in this kind of a situation when the risk of a dramatic market crash becomes very, very high. And so many investors right now don't understand this. They're kind of the mentality that the Fed can always keep asset prices propped up. And this simply is not true for several reasons. Firstly, the amount of money the Fed would need to, print to prop up asset prices on their own without investors would be immense, at least in the tens of trillions of dollars, probably even more than that. Secondly, with the amount of leverage that will be in the markets at that point in time, and that currently is present, but looking forward just with the amount of leverage that will be there, currently we have over a quadrillion in derivatives. So when moves in the markets do happen in the negative against the direction these derivatives are going, they will happen extremely quickly, probably more quickly than has ever happened before, simply because of the historic levels of leverage which have never been present in the entire system before. And we've all seen what extreme leverage can do recently with the example of all of these heavily shorted stocks such as GameStop, AMC, Nokia, etc. It didn't matter what the valuations were, whether they were justified or not. The prices simply moved so dramatically because of this extreme amount of leverage. And I'm not saying that the markets as a whole would behave as extreme as this one small company's stock, but you get the picture. The greater the leverage, the more dramatic the moves can and do happen. And when momentum begins building in one direction against the direction of this leverage, it amplifies the momentum, and then this leads to a cascading effect. So this video is not to be taken as some sort of doomsday prediction or recommendation for any specific hedge against this. Rather, this is more of a summary of why this melt-up is currently underway and a warning of why to be cautious currently and going forward. So I hope you guys like this video regarding one of my favorite investors and strategists to talk about. I hope to have David on here at some point and actually have an interview with him, as I'm sure that talking with him and not just about what he said will help both me and you guys to understand his views much better. So with that being said, I will sign off and I hope to see you again.